This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Thursday morning, and I'm Prashant. With me, as always, my colleagues Sonia and Nigel. Morning, guys.
Morning.
Hi, good morning. Thursday morning. And yesterday you had a good pullback, right, in late trade. But this morning, once again, global cues are not really supporting us.
You know, it's almost like maybe a third time lucky. I don't know if it'll be third time lucky, but two times we've kind of followed the price pattern. So let's quickly kick it off there in terms of what happened, right? So it was almost a repeat of the price action that we saw on Monday, that we saw yesterday. The Nifty sold off, the day's low was made early on, and then the rest of the day was spent in repair, and the market basically moved up consistently. We actually ended positive. So it was a better outcome as compared to what we had on Monday. Tuesday was a holiday. So 2 days now we've done this. We've woken up to weaker global cues. The market has reacted, and then it's kind of moved up. I'll come back to levels in just a bit. But so for the third day in a row, global cues are also similar. They're weak. You've got the S&P, which was down, the NASDAQ, which was down as well. NASDAQ down a little bit more, 1.15 odd percent. By the way, this is the worst two-day fall for the S&P 500 since April. The S&P 500 in Tuesday's US session broke below the 50-day moving average. And, I mean, setups are not looking all that great. It's possible that the S&P, I mean, if the decline is not arrested, sort of retests, or rather tests for the first time after a long time, the 200-day moving average, which is closer to 4150. That's about 5.5% away from here on the main US index, right? The decline in the US started with AI stocks, which were the big outperformers, but now it's spread to cyclicals as well. So it's a slightly broader kind of pullback that we are seeing. At least it looks like the beginning of one. We'll see. By the way, the US market and the Indian market have been the strongest markets in the world, right? Not just this year. You could look at the performance last year or the year before that. So the question is, if the US goes into a bit of a funk, can the market here also completely overlook, or we'll kind of, pay the price maybe to a lesser degree? We'll see. The other problem is the bond market. So bonds continue to sell off. Yields are up. The 10-year yield went up 6 basis points in the US. It's at a new cycle high of 4.27% now. So this is number one. Number two, as a consequence of this, dollar is strengthening. It's now almost 103.5. So yields up, dollar up. The only silver lining is that oil prices are down. And, they were down yesterday. They're down this morning by 2%. Which means that in the last 3 trading days, oil is down. Some Brent oil prices are down 4%. That is meaningful. That is substantial. So while dollar hurts, yields hurt. On the other hand, the softening that we are seeing in oil perhaps helps at the margin, and that's why I'm saying it perhaps is a bit of a silver lining. Let me just look at the overall levels and how things are looking. So as I said, we respected supports, we bounced and closed above the 40-day exponential moving average, which is 19,360. We ended clean 100 points above that particular level. So that's the first level to defend, right? 19,360 on a closing basis. Should hold. It has held on Monday and yesterday as well. But for signs of revival and the fact that, for us to say that this short-term correction is behind us, you need to close above almost 19,500. 19,498 is basically the level, which is the 61.8% retracement of the recent fall, which is the recent high to the low that we saw 2 days back. Bank Nifty, though, is a different index. It's looking much weaker as compared to the Nifty. It's trading close to the 20-week moving average, which is 43,875. So that's the first number that you need to kind of watch out for. Below that, you got the 200-day moving average, which is, a couple of percentage points away. That stands at 42,752. So far, we've got no help from the Nifty Bank, even as the Nifty has come up and recovered in the last 2 sessions. So that is the weaker part of the index. We'll see. It's also heartening, I must add, to see that even though the Nifty was doing whatever it was doing, the small cap index yesterday ended up 0.6%. And that has been one of the strongest indices, not just here in India, but around the world. The Indian small cap as an asset class has been extremely strong, and that performance continued with all of this whipsawing that we've seen in the last two sessions. Sonia.
Absolutely. And, I think there are two key reasons that the market globally is a bit under pressure, right? One, of course, is the fact that the FOMC minutes hinted at more rate hikes. And two is the China economic concern. So these are two key reasons why the markets were under pressure globally. And even in the Asian markets this morning, actually, there's quite a bit of, downtick that we're seeing across markets like Hong Kong, etc. So apart from that, the Nifty yesterday still is holding on to the 50-day moving average. It's held on to that 19,400 mark. There was a pullback in late trade. And largely, give and take everything, it's been a pretty range-bound market. So the range has been about 19,400 to 19,800 on the upside. If you look at the data from the FIIs, there was in fact good data that came in. Both FIIs and DIs bought in the cash markets yesterday. So we had about 720 crores of cash buying from FIIs. DIs bought almost 2,400 crores. So in that context, it was a pretty good day. Now the earnings season is finally behind us, and a lot of brokerages are coming out with their notes as well. Motilal Oswal put out a note this morning where they said that the earnings season has ended on a very strong footing. In fact, they've raised the FY24 Nifty EPS by 2.5% to 988 rupees, and they have upgraded earnings estimates on many companies, whether it's Tata Motors, JSW Steel, SBI, Kotak Mahindra Bank, and Bharti Airtel. So that's at least one validation to the earnings season coming in from Motilal Oswal, saying that it's been a strong season, and that's perhaps what the market could latch on to and build on to as well. But just purely for today, purely for the morning, could be a bit of a choppy start, considering that we have this cloud of, the FOMC suggesting more rate hikes and some concerns from China as well.
Well, that's right, Sonia. We're bang in the middle of the range, right? Yeah. On the downside, 19,250, and the upside, 19,650. So we're at around 19,450. That's bang in the middle. The problem is that the global picture is still very, very nervous. You can't keep getting very strong data coming out of the United States and very weak data coming out of China. That's what's putting the globe in a bit of a tizzy. And obviously, the Fed rate hikes as well, that's what's playing on minds of investors. Now, how are the FIs? How are their positions? Well, they're positioned net short. Close on 61% of their positions are on the short side. And on the opposite side, they bought a little bit more puts in comparison to calls. But on the writing side, they wrote an equivalent amount of calls as well as puts. Which brings us to the data point. Yesterday, actually, we ended higher. We recovered a goodish bit from the low point of the day. But I'm looking at two in-the-money call options, 19,400 call, 19,450 call odd. The premium out there did come down despite you getting the direction right. Yes, there was that intra-week holiday that we had, but the decay on the premiums was faster than expected. Tell you there is still some writing being seen at those levels. And on terms of the highest open interest, well, you have the 19,300 put as well as the 19,400 put. They have the highest open interest, which brings us to the levels. Now, the 20 DMA, well, that's a resistance, and that's going to be quite a stiff resistance. But in the near term, going by the data that we saw, 19,400 call, 19,450 call, keep in mind, you got the direction right, but yet the premium came down, telling you there is aggressive writing being seen at those levels. So for today, 19,520, that becomes a bit of a resistance zone. But since we have the highest amount of open interest on the put side at around 19,300, well, that becomes the support zone. 19,250 to 19,300, when we've gone out there, we have seen a bit of a bounce. The Nifty Bank as well, that as well is bang in the middle of technical levels. The 50 DMA as well as the 100 DMA, both those two levels should come up for you on the screen. They're close to around 1,000 points apart, but we're trading right in the middle out there. And that's going to be a bit of a swing factor as well. The GIFT Nifty suggesting we pull back a little bit. Today is the weekly expiry as well. And as positioning stands, we don't get past the 19,500 odd mark. So let's see whether or not that buy on dips works out. But I think buying closer to around 19,250 to 19,300 makes risk reward favorable. Today, I think you want to wait in there, wait for a couple of hours and then see how it plays out.
Okay, well, that's the trade setup as we are looking at things this morning. Before we go any further, let's quickly tell you what's lined up here in the first half hour of the show. We get you updates from markets across the globe. Jahangir Aziz at JP Morgan will join in and he'll set us up on that front. Our research team will get you CNBC-TV18's list of top 10 stocks for the day at 8:30. We do a fundamental stock check with Anand Tandon will be with us.
All right, let's kickstart the show very quickly. We have a comment, in fact, coming in from Mahesh Nandurkar of Jefferies, who says their coverage includes or rather their coverage excluding metals and oil and gas, reported a 20% year-on-year earnings growth, continuing the strong earnings run of the past 3 years. He says the jump in oil PSU earnings and strong performance from lending financials, autos and pharma were the highlights. He adds domestic companies' margin performance was flat quarter-on-quarter. He says operational commentary stayed positive on the capex trends, but weakness was visible in consumer discretionaries and quick service restaurants.
Okay, some money market views. Parul Mittal Sinha says that the USD INR is likely to see an upward bias on spike in dollar yuan, global risk off on August seasonality and higher global yields. She expects the dollar INR pair to trade between 82.8 to 83.5 next week. Adds US dollar sales by PSU banks may keep a lid. Forex moves will be led by risk sentiment, oil prices and central bank intervention.
All right, and on the bonds, Parul says domestic yields are likely to see some upward pressure post the vegetables-led July CPI data surprise amidst muted core inflation. She expects the 10-year benchmark bond yield to trade in a range of 7.1 to 7.25%, with an offering bias seen in the near term. She says global yields, oil prices and domestic food prices would stay the market drivers.
Well, we have a lot of stock-specific action to track for you. We'll get to that in just a bit from now, but let's run through the list then. In our special top 10 segment, we're looking at Kotak Mahindra Bank, RVNL, Ircon, JSPL, Adani Power, JSW Energy, Relige Enterprises, IIFL Securities and Lupin. All of them, their stocks on our radar on the back of positive news flow, while on the flip side, Portfolio will be reacting to negative news flow.
Okay, well, Jahangir Aziz is now joining us, Global Head of Emerging Market Economics at JP Morgan. Jahangir, it's always a pleasure. Great to have you with us here on the program. What's going on in the world, Jahangir? It seems like, a study in contrast. Things in the US are so good that it's actually turning out to be bad for markets. And in China, it just is bad. So two engines, two largest economies, are pulling in the opposite direction. What does it mean for markets?
So I think the market is slowly getting into that shift, or increasingly realizing that probably there should be attention to this growth shift that is taking place, where, as you pointed out, the US economy is chugging along. We had a call of recession, which we took off. So we are now looking at a baseline of a soft landing taking place. If you look at the Atlanta Fed's nowcaster that came out, I think last week, or just after the retail sales number came out, it's showing a 3Q growth that's now running around 5% of the nowcaster. We don't have 5% for 3Q growth for the US. We have about 2.5%. On the other hand, it's not just that, China is languishing. On top of that, you have serious concerns about the euro area. If you look at the IP numbers coming out of your euro area, they're terrible numbers. So I think that, it's not just that China, one engine of growth is sputtering. It is that euro area is also sputtering. US is the one that, is essentially chugging along, probably going to avoid, a hard landing, and as a result, all of the rate cuts that people had sort of priced in is being pushed back. The growth differential between the US and the euro area and US and China is actually hardening the dollar. So we have a situation where not only are long end of the curve moving up because the rate cuts are being pushed back, the curves are steepening, and on top of that, you have the dollar hardening, and the combination of all of that is essentially working on the equity market in the US, for example, at this point in time. But I think that, if you take out China and euro area, and even though these are large negative shocks to the emerging market economies, if you look at the emerging market economies, they are still continuing to show this remarkable resilience that they have shown throughout this year. And almost all my country economists are actually pushing up growth forecasts for most of these economies. So I think that, you're probably entering into the world where the US and emerging market ex-China is going to do reasonably well, even though the background against which they're doing well, which is, euro area and China, pretty much in a very sluggish zone, is going to be the big headwinds.
Okay, but Jahangir, hi, good morning. The worry also stems back home, right? I mean, the retail inflation at a 15-month high. Now there are talks of perhaps the RBI hiking rates once again, and rate cuts getting pushed way back into, way forward into FY25. What is your view of how things could move back home?
Look, you have El Nino, you have a monsoon rain shortfall, and if you don't expect agricultural prices to rise, I mean, you must be living in a very different reality. So yes, agricultural prices will rise. Look at the print. Yes, the headline surprised us, but look at the core inflation. It actually went down from 5.4 to 5.2, if my recollection is right. So I think that, you are getting the benefits, and I've spoken about this in the past, you are getting the benefits of very strong export price deflation that is coming out of China. And that is keeping not only goods disinflation down globally, but it's also, keeping core inflation down in India. And I think that's going to continue because, China deflation is probably going to be there for the next 3-4 months. But, RBI clearly is going to look through this rise in agricultural prices. I think the concern for them will be that does the rise in headline inflation, does the rise in agricultural prices get passed on to core inflation? I think they'll wait for that. But waiting for that is going to be a long period of time because waiting for that means that both the Kharif crop and the Rabi crop has to actually be normal. And that is the reason why I think that, the rate cutting cycle for the RBI probably gets pushed back into calendar year 24, maybe in the middle of calendar year 24. But I think the benchmark for a rate hike, just because agricultural prices are rising, I think that's a very, very high benchmark.
Hi, good morning, Mr. Aziz. So the RBI, rate cuts, I think an optimist would say end of this year, but that seems, very far-fetched going by the data points that we're getting. What about the Fed, Mr. Aziz? I mean, what kind of tragedy are you looking at? Because the retail numbers are looking so good and, very, very strong. But how many more rate hikes do they have in store?
So I think the India issue is much simpler. So we also had a rate cut in the fourth quarter of 23, which we pushed back into 24 because, on the grounds that the RBI is going to wait for agricultural prices to normalize. But the Fed problem is probably much more complicated, given the fact that retail sales, and look at the IP numbers that came out this morning. I mean, both of them were significantly above what expectations were. And I think that even though the benchmark for a September rate hike is still high, and we sort of don't think that the Fed is going to hike, but remain on hold for an extended period of time, again, letting the long and variable lags to work through. I think even though that is a baseline, the risk still remains that after waiting for some period of time, if indeed you do not get inflation down to your comfort zone of 2.5-3%, and non-farm payroll numbers keep chugging along at above 100, 150, I think there is a very good chance that sometime in 24 you might see the Fed rehiking. But I don't think that the Fed is going to hike, without pausing for a considerable period of time to allow the market and allow this banking sector and to allow the economy to actually absorb that 525, 550 basis points of rate hike that they have done. They have already talked about that, and I think that they need to let the economy actually adjust to that.
It's been incredible, isn't it, Jahangir? 500 basis points, and still, as you said, the economy is chugging along. But these things work with a lag, so maybe it'll show up.
Yes, and that's basically the problem.
Yeah, so we're in the transition kind of period.
It's not just the lags. The lags are variable, right? So the lags could actually work later in the period rather than in the first 4 quarters. It could work much more strongly in the 6th to the 8th or the 12th quarter. And that's the problem with these kinds of monetary policy hikes.
Yeah, no, absolutely. Got it. So got it. So emerging market and US are fine, which means markets there perhaps will be fine. Ex-China, ex-Europe, right? We can live with that.
That's correct. Well, I think the real worry is Europe and China, and clearly there'll be spillovers right, from Europe and China. It is going to slow down emerging market because we depend on all 3 economies to keep our economies going. So I'm not saying that the emerging markets growth is not going to slow down, but the growth is not going to, it's not going to be a cliff that they're going to fall over, which is what we were afraid of even, 4 or 5 months back.
All right, Jahangir, we'll leave it at that. Thanks a lot for joining in and have a great day. So emerging market economies are showing resilience, but the real concern stems out of Europe as well as what's happening in markets like China, with the economic data being weaker than expected. All right, let's do one thing. Let's take a quick break. On the other side of the break, our entire research team will be with us to give us the list of top 10 stocks that we need to watch out for today. Welcome back to Bazaar Morning Call. So we have plenty of stocks to talk about and we have our entire research team joining in to help us with that list. Kotak Mahindra Bank is the first one on our radar. Abhishek is here. Abhishek, good morning.
Good morning, Sonia. So, Kotak Mahindra Bank was present at Spark conference. The key takeaways from that conference highlights is that they intend to take the unsecured portfolio to 15% of the total loans from 11% that it is there currently. They have appointed Mr. Rohit Basin from HUL Singapore for the marketing side of their business. Liability side, their focus is on gaining deposits in active money, which is costing higher than saving deposits. So, it's costing about 7% when compared to 6% that they pay on saving deposit, but it is lower than what they pay on the term deposit, which is north of 8%. So 811 account, 81% of 811 customers are less than 35-year-old and they have higher average balance than saving deposits as well in some category. So they don't want to chase size at the cost of value in terms of home loans. 150 to 200,000 customers are being added via branches. However, through digital platform, 6 lakh customers are being added. So not much of branch expansion is what they are focusing on, and they are focusing on consumer loans to increase while wholesale loans to reduce. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Vivek. He's here to track some of those railway-related stocks. Morning, Vivek.
Well, good morning. I expect the entire spectrum of railway stocks to continue to remain in focus. Some significant news flow coming in overnight. So what's actually happened is that the cabinet has yesterday gone ahead and approved 7 multi-tracking projects worth over 32,500 crore. Now, these projects will cover 34 districts in 9 states, including the key states of Maharashtra, Gujarat, UP, etc. Now, along with that, what actually happens is that the existing network of the Indian Railways will increase by 2,339 kilometers, while, all of the railway stocks will remain in focus. Further details in terms of, who exactly is the PMC, the project management consultant, and, who will be the suppliers of all of these makers. We are still awaiting these details, but it's a broad-based positive development as far as railway sector is concerned.
Vivek, thanks very much for that. Well, after a brief 2 or 3 week break, blocks are back and how. And Nimesh is here to tell us the blocks which happened yesterday, the sellers, the buyers, and of course there's lots lined up today as well. Nimesh, take it away.
Hi, Prashant. So there are a couple, 4-5 stocks. I'll start with Adani Power first. Huge block, 8% equity got changed hands. Confirmation as well, at the end of close that the promoter entity was a seller. So they've sold close to 8% of the company's equity, and a single buyer, GQG, has bought a large chunk of that equity. So nearly 9,000 crore is what the GQG is investing now in Adani Power. So that's the first one. I'll go with green there. The second stock is JSW Energy. Even that was part of my charter list. Confirmation of the promoter entity was a seller in yesterday's block. 2 crore shares got sold. And again, GQG was a buyer. Nearly 1 crore shares bought by GQG in JSW Energy as well. So that's the second one. The third stock is really good. Mangalam had put out a story in the morning yesterday, and there is a confirmation as well now that the Burman family, the 3 entities of Burman family, they've bought close to 5% of the company's equity. So their holding goes up to 19% now. And it was a clean-out trade from a Singapore-based fund. They sold out entire 5% stake, which is 2.5 crore shares. And the last one is IIFL Securities. The Prem Vatsa's fund has sold close to 60 lakh shares in a block deal yesterday. There was a lot of chatter that some large HNIs have bought. Some names have come, but largely the Prem Vatsa's fund has sold 60 lakh shares in IIFL Securities yesterday.
All right, Nimesh, thanks a lot for that. And normally we look at the end of the day large trades to find out who the party is. Once Nimesh tells us in D-Street Chatter, we just look for the confirmation. So congrats, Nimesh. Most of them nail on the head on those. Well, let's move on. Sonia, you're watching Vodafone Idea as well?
Oh, yes. So, Vodafone Idea had a conference call, and it's not, the takeaways were not that great. So I'm going with red on that stock. They talk about how the fundraising, which is the big trigger for them, that continues to remain elusive. They have had multiple talks, multiple discussions, and nothing has closed yet in terms of fundraising. They have not even reached the final stages in terms of a discussion. And hence, because there's no fundraising happening, the liquidity constraints continue, and that could impact their network investments on both the 4G coverage expansion as well as the 5G rollout. Now, what this means is that the subscriber base could continue to decline for them, which is a big negative. And they've decided not to take the lead on any tariff hikes. However, if competitors raise tariffs, then they are happy to follow. Now, what this means, of course, is that Vodafone could be in the red today. JP Morgan has a target price of 3 rupees on the stock, so they expect a big downside. But this would also mean, positive for the other incumbent players, both Bharti and Reliance. So I'm going with green for them.
Okay, Sonia, thanks for that. Well, let's hop across to Ekta. She's here to tell us more about Lupin. Ekta?
Thanks for that. Well, the big and much awaited launch has come through for Lupin. They have launched Spiriva generic, which is basically the inhaler used to treat COPD, chronic obstructive pulmonary disease, in the US markets. Remember that it's a $1.2 billion market size in terms of drug, and they are expected to have exclusivity or less limited competition at least for the next 3 years, according to analysts. Now, this news was already factored in, considering that they had received US FDA approval in June, and this is a story that Vivek had broken on CNBC-TV18 as well. Now, in terms of the approval, in terms of what they could make from this particular drug, they could see revenues of around $35 to $40 million in FY24, $130 million in FY25, going up to $150 million in FY26 from just this particular drug. Now, Lupin's US generic sales could also rise all the way to $850 to $900 million, simply because of the momentum from this particular drug as well as others. Now, we expect the stock to be in the green today because of that sentiment and the positivity that we've seen in terms of Lupin and the spate of launches. But remember, the stock has already rallied significantly.
Okay, thanks a lot, Ekta, for that. Well, let's take a quick look at all of the stocks that we're talking about today. With positive news flow, there's Kotak Mahindra Bank, RVNL, Ircon, JSPL, Adani Power, JSW Energy, Religare Enterprises, IIFL Securities and Lupin. while Vodafone Idea is the only stock with negative news flow on our radar today. But let's find out what's happening in the world of crude. Brent crude prices are actually now at almost $83 a barrel. There are some concerns in China as well with regards to demand as well as the economic slowdown. Manisha Gupta is here to give us a roundup of all the action there. Manisha, good morning.
Morning, and thank you for that, Sonia. Well, yes, the crude oil prices have continued to decline. A fourth straight day today, by the way, and we're trading at a 2-week lows right now. So with the dollar index trading at a 6-week highs and weak economic data continuing out of China, the pressure in the energy markets has just about continued. And not just that, the metal space is extending the declines as well. So you are looking at the Fed policy minutes signaling more rate hikes on table. That doesn't augur well for the space. You have copper prices now trading at a 7-week lows. It's a 2-month lows continuing for silver, steel and iron ore as well. Zinc clearly an underperformer. We've seen nearly 3% decline overnight in case of zinc prices. And with that, it brings the prices to 2.5-month lows. So further pressure is what the street is anticipating, and we're down by nearly 4 to 6% for many of these commodities already into this week.
Okay, well, Manisha, thanks very much for that. We'll take a quick commercial break here. Up next, Anand Tandon will join in for a quick check on stocks. Lots of stuff moving around. We have an interesting conversation lined up. After that was Rahul Sahai of Kirloskar Oil Engines. We talked to them about business, first quarter numbers and the outlook ahead. Stay tuned.
Welcome back. Hope you're having a good morning. Well, we just told you about the stocks you need to track. So let's discuss some of them in more detail. Market expert Anand Tandon joins us on the show. Hi, Anand. Good morning. Thanks so much for joining in. Well, yesterday we had 2 large trades on a couple of the power energy-related companies, JSW Energy as well as Adani Power. Promoters, they are cashing out a little bit, but good funds are coming in there. What's your view on, let's start off with Adani Power first, if any view at all at these levels?
Well, the sector per se looks to be quite interesting. Energy is a sector, especially power, which has not been invested in too much from a fund perspective. So, unlike, for example, banking and finance, where most funds are overweight, here is a sector where I would argue that, there is, except for NTPC, where a lot of people have been buying and therefore the stock has done well. The sector has been doing reasonably well. Just a few years back, the demand was not showing up. many of the companies were trading at actually below replacement value, and most states, for example, were unwilling to buy on a fixed contract basis, saying they can get it cheaper in the market. Situation now totally reversed. Most of the power companies are able to sell at fairly high value, and the demand has also gone up quite considerably, especially since monsoons have not been as good across the country overall. Whenever there is higher heat, there is greater demand as well. So overall, the demand outlook looks quite good. Because of the fact that there was a bit of an oversupply, there has not been great capacity addition. So overall, that sector, therefore, to my mind, is fairly interesting. Valuations still remain broadly in line. I don't think that there is something which is, very highly overpriced. JSW Energy, for example, was one of those which was finding difficulty in getting fixed rate contracts for a long-term period. So obviously, when the situation turns, those kind of companies do well. Overall, I think I have a bullish view on the sector.
Okay, bullish view on the sector. Anand, hi, good morning. I wanted your thoughts on Lupin. That stock has gone up, 70% in the last 6 months. It's had a great ride. But there's also now a lot of positive news flow, right? They've launched that Spiriva generic in the US market, and that's a huge market size, almost $1.2 billion. Do you think there's still more to go on the upside here?
From a momentum perspective, yes, pharma after a long time has done well over the last couple of quarters. But if you look at where the valuations for most of these companies have reached, I mean, Lupin itself, you can, let's say, factor in it had a degrowth last year, so you can factor in almost 200% growth this year. And even after that, it will be trading at upwards of 30-35 times 1 year forward earnings, and perhaps 28, 29 times 2 years forward earnings, at which point you are not left with too much of a valuation gap. But that's also the story for the rest of the market. Overall, to my mind, most of the companies which are in a upswing are trading at a higher valuation. So from a portfolio perspective, I would still remain with pharma. And as you mentioned, since Lupin has one of the biggest deltas in terms of the earnings, it's something that you may want to continue to hold on to. But remember, there is now increasingly very little chance for error on the downside.
Okay, Anand, stay with us. Good morning. I'm just going to come back to you, but you may want to listen to this next conversation. We're talking to the management of Kirloskar Oil Engines. They're one of India's leading genset sort of manufacturers. Numbers have been looking up, and the segments that they operate in, which is largely agriculture, that has also been doing very, very well. So, demand seems to be robust, and the runway for growth seems to be pretty healthy as well. Rahul Sahai is CEO at Kirloskar Oil Engines. He's joining us right now to take some questions. Rahul, good morning. Great to have you with us here. Appreciate your time on CNBC-TV18. So numbers have been looking good, Rahul, and markets have taken note, obviously. But I just wanted to get a sense from you on a slightly broader basis. What should we expect? Will some of earlier complained that this perhaps is a bit of a cyclical kind of an industry. Are we in for at least a couple of quarters of a strong growth here? What are the big triggers we should watch out for? And what is the outlook for the business?
Right. First of all, thank you for having me here, Prashant. I think it's an honor. So to answer your question, the way I would look at it is last year, we as a leadership team released a guidance where we said that we will grow by 2 times over the next 3 years. And this is taking into cognizance the kind of capex cycle that we are seeing, and also the kind of focused initiatives that we are driving to ride those capex cycles. So if I look at the order board we currently have, we have a very significant order board, both on our power generation business, as well as if you look at our industrial business and the international side. So just from a demand standpoint, the demand seems very robust. Some of the key segments that are driving that are all the infrastructure initiatives that the government is taking. There is a lot of focus on data centers, so there's a lot of demand coming in from some of these segments. So I think all in all, it's we're seeing robust demand, along with I think what is definitely helping is the capex cycle, and that's a strong tailwind in this entire process.
So you said that there is demand coming in from many verticals. The government is also pushing a lot of segments, including data centers, which is big now. So can you tell us, you're diversifying and getting into many new focus areas as well, whether it's the water management segment, bio-waste management, firefighting, pumps, etc. What could the revenue mix be 1 to 2 years down the line? Where do you see the maximum contribution coming from and maximum growth as well?
Right. So if you look at our businesses overall, as a intention and a clear strategy, we are trying to grow our international business. Now, some of these products are being launched because we clearly see a need for these products in the market, and we are positioned well to execute and drive growth through these products. But from an international standpoint, as we've communicated in our 2X TY strategy, that's the key focus area for us, and we are looking to grow to close about 30% contribution over the next few years, so as part of our growth plan.
So currently your export contribution is 12%, right? Of the total revenues. So you're planning to grow that from 12% to 30% over the next 2 years, you said?
That's right. That's right.
Okay, and what would this mean in terms of your operational performance? Because of higher exports, can you scale up your margins as well? And if yes, what would that range be?
So exports typically so they are margin accretive. They're definitely, they support the entire margin profile of the organization. And if I look at, so I won't give a specific guidance on the margin, but what I can say is it'll definitely be better than where we are positioned today.
Okay, all right. Hi, Rahul. Good morning and good to speak to you. Nigel on this side. Just focusing on margins though, give us a directional view. I'm looking at your B2B and your B2C segment. Now, the bullish people on Kirloskar Oil Engines, they argue that maybe you should get a better multiple because the nearest competitor is Cummins. But for that, the margins have to improve, and they have improved. What is the trajectory on the margin front on the B2B segment, point number one? And point number two, on the B2C, that's far smaller, but margins are at mid-single digits. Is there a scope that you take that to double digits at some point of time? So margin trajectory on both B2B and B2C.
Right. So if you look at what B2B business is, it's largely our power generation and engines business. That's the business I also drive. My colleague Asim looks after the B2C business. But if you look at the margin profile, there is a clear focus from both of us to ensure that we are growing the margins. Now, at a B2B level, we typically operate about 14% EBITDA, and because of the international growth, we are also looking to grow that. There are opportunities with new product launches as well as growing the aftermarket business. So there is a significant opportunity there. On the B2C side, we are again looking at growing the margins, and I'm sure Asim and the organization will come close to double-digit EBITDA in due time.
Okay, all right. Rahul, just one more question. Arca FinCap, pumped in, I guess, close to around 1,000 crores out there. But in the past, you'll have hinted there could be some kind of value unlocking that will come about. Could you tell us what is the plan out there? Maybe a demerger, maybe listing this entity separately. Is there something like that on the cards? Because 1,000 crores has gone in. I believe that you're not going to put more money, right?
So I think at this point, it may not be appropriate for me to comment on that, but we're definitely looking at all options.
Okay, looking at more options. Just one final question before we let you go. You said that you're looking to take the export contribution from 12% to 30% in 2 years, 2 to 3 years. What is the market share currently in the power gen business? I think it's a little over 30% if I'm not wrong. The market share, how much can you grow it by over the next 1 to 2 years?
Right. So if you look at our power generation business, we have close to about a third of the market. So by volume, we're the largest player in the country. What we are looking to do is enter spaces that we've not historically been dominant or significant in, especially on the high horsepower side. So there is a clear focus on driving growth through our MHP and high horsepower range over the next few years. So I think from a market share standpoint, we definitely gain overall.
Oh, just quickly, with regard to their NBFC, all options are on the table. But by when will we hear about one of those options? When will you all decide? In this fiscal year?
I don't think it will be appropriate for me to comment on that. I think we'll wait for the announcements to come.
Okay, then
but Rahul, you'll spin it off, right? I mean, that it makes sense.
Yeah, so like I said, we'll kind of evaluate that, whether spinning it off makes sense or what needs to be done and what is the timing. I think the timing becomes more critical.
But the direction is such that you'll look to unlock value. Either it's listing it separately, demerging it, something like that, right?
Yeah, I don't think I can comment on that specifically.
All right, Rahul. Okay, all right, Rahul. Maybe the next time we chat, we'll have further clarity. But clearly, you're sounding very optimistic on business, and margin improvement in both your segments is what you're focusing on. It's a good chat. Thanks so much for stopping by this morning and speaking to us here on CNBC-TV18. Well, let's get back to our chat that we're having with Anand Tandon. Anand, you heard the conversation we had with Kirloskar Oil Engines. Any inputs on either this company or maybe a Cummins?
Well, this is the one sector which is a bit. So generally, industry is doing very well, right? That goes without saying. Why diesel should do well is a question, because by and large, diesel is used when you're doing a backup. So assuming that your power situation improves, this should be a declining segment. Also, from a climate change perspective, is something you should be discouraging. Now, that said, it hasn't happened yet. Volumes continue to grow. And from a near-term perspective, obviously, you would expect to see margins also improve, not because of much that the company is doing. More importantly, simply the fact that, you would expect raw material prices to fall. If you look at what WPI versus CPI is telling you the story, CPI remains high, WPI has gone into negative territory. Margins for corporates will improve from here on for the next couple of quarters at least. So overall, you have a situation which is one of the less expensive engineering companies with a reasonable brand name going back many decades, and now trying to improve the numbers, which should happen. The thing I don't like is the NBFC coming up. Sucks up a lot of money. Everybody thinks they can run NBFCs, and the answer is that they can't. So one has to look at what happens, how much more money will go into that. Right now, of course, it is limited, but that said, that's the one area of concern. Exports, if they grow, and they have been growing fairly quickly, 40% growth has been achieved, is a positive sign. To that extent, overall, I think, on the balance, it would still be something that you might want to look at.
Okay, all right, stay on. We'll come back to you. We have many more stocks to ask you about. We also want your thoughts on the IT space, which has come back in a big way, right? All of that coming up. But before we slip into a break, let me tell you what's lined up in the next half hour of the show. Anuj will be joining in for a quick trade setup. After that, we have the top stock picks for the day from our technical and F&O experts. And before the market opens in CNBC TV18 Stocks Board, we will highlight the top stocks in the news to focus on for the day. Stay tuned.
Okay, welcome back. You're with us here on Bazaar Morning Call. There's 15 minutes to go for the pre-open session. Anuj is here with a quick check on what the setup looks like. Anuj, morning.
Morning, Prashant. And you know what? The setup is actually quite interesting. Yesterday also we made this point that there's a bit of a dichotomy between Nifty and the bank Nifty. I mean, it's like that famous Ajit dialogue, liquid oxygen. It's one sector which is very strong, which is Nifty IT, and one sector which is very weak, which is Bank Nifty. Just look at what the Nifty has done and what Bank Nifty has done. This is a Nifty. Look at the lows of last 2 days, 19,257 to 19,377, which means a higher low. And look at the high, 19,465 to 19,482. Even by 17 points, but a higher high. Now look at what the Bank Nifty has done. The same plate would come up for Bank Nifty. This is you have the lower high and lower low. 14th August low was 43,776. Yesterday's low was lower than that, 43,600. The high previous day was 44,212. The high yesterday was 44,002. So clearly, the Bank Nifty is underperforming a bit. But if you go by the Nifty, clearly there's very strong recovery. On both days, August 14, we recovered 176 points. And yesterday, from 19,317, we recovered about 148 points. Another internal which tells you why this is happening is what's happening with the index futures data from the FIs. And now, of course, we get segregated data from the NSE. On the Nifty, there was futures buying of 506 crores. On the Bank Nifty, there was futures selling of 285 crores from FIs. Net, there was buying of about 221 crores. This market has given you signs of resilience and some signs of bottom. And now only if you breach 19,257 will the market become weak. Though only intraday trades are working, because overnight you're again getting some kind of a gap down. So texture is to buy in the morning and close your positions by evening. The Nifty is refusing to fall below the 50-day moving average, and the Bank Nifty is refusing to fall below the 100-day moving average. And SBI yesterday led the recovery in the Bank Nifty, which is a bit of a positive sign. So Nifty IT strong, won't let Nifty fall a lot. I think the other big cue today would be the money market, because money market was closed yesterday. It opens at 9 a.m. Let's see how that reacts to that ugly inflation number, because equity market reaction was quite resilient. Let's see if the money market is all right or not. Just a last word on the Nifty about the levels to watch out for. The first support zone is 19,370 to 19,400, given today's options expiry. And the bigger support is, of course, the last 2 days low, 19,317 to 19,257. But my base case is that the market shown enough resilience, enough signs that it wants to make some kind of a bottom somewhere around 19,250.
Anuj, you said that Ajit dialogue. There's that new age. What is the Pushpa dialogue, right?
No. That it's a liquid oxygen.
I know that. I'm just saying that the motto of the market seems to be the dialogue from that movie.
Pushpa.
Jukne nahi dega.
What are these movies you guys watch? I didn't even understand.
You've not seen it's outstanding.
You've not seen Pushpa?
No, I haven't.
You've not seen Pushpa? Come on.
I don't even plan to.
Oh, I think that's your loss, Sonia.
Is it as bad as Oppenheimer?
No, it's your loss. It's
that's under the
below the belt. All right, Anuj, thanks a lot for joining in. Have a good one. We'll chat later. Mitesh Thakkar and Sudarshan Sukhani are joining us now to tell us how to approach the markets today. Sudarshan, good morning. Your thoughts on what's happening in the market now? Anuj was suggesting that there could be some sort of bottom formation around the lows, maybe 19,200, 300. Is that your view as well? That even if this market doesn't rise, the base of this market has moved higher now?
Yeah, good morning. See, we are in some kind of a correction, and it's not just India. Most world markets are. So I don't think corrections should be traded at all. They are not easy to trade, and while we have seen 2 days when the markets opened lower, went up, then had a gap up of a very different kind, something reverse can happen today. I mean, correcting markets are unpredictable. So serious traders try to avoid it. And my suggestion was the same yesterday and on Monday. Avoid the Nifty completely. It's not easy. It's theoretically easy to catch these moves, but practically not possible. Just step aside and let the market decide whether it wants to hold on to support or whether it wants to break down. It's not tradable. The Bank Nifty is tradable on the downside. If you see small rallies, buy put options, essentially a bearish trade on the Bank Nifty, there is more downside possible.
Okay, all right, got that, Sudarshan. Thanks for that. Morning, Mitesh, coming to you as well. What's your view on the index?
Morning, Najib. So, I've been advocating some kind of a range-bound movement which could develop, given the fact that we've given a correction, we've given a pullback, and we haven't tried to fill the weekly gap around the 19,200 mark. So, I still believe that will be the bottom, and therefore, while in the middle of the range, you would want to avoid trading, but at the edges, you would still want to trade. So, I would be a buyer closer to 19,250, 270. Be a seller and even attempt shorts above 19,620, 650 zones. So, I think that's the way we'll approach it. Till then, I think it's more of stock-specific market. Once the market comes into the middle of the range, once the indices are in the middle of the range, I think then you will have to trade with stock-specific biases.
Okay, so let's get straight to that then. Mitesh, what would be on your list this morning?
So I have a buy on Infosys. I think with yesterday's good news, it's triggering some kind of an up move. Buy here with a stop at 1400. Look for targets of around 1455. Also a buy on Colgate Palmolive with a stop below 1980. I would want to buy once it clears yesterday's high. So buy above that and keep a stop at 1980. Look for targets of 2075. One sell on Bharati, that's a sell with a stop at levels of 866 and a target of around 835 to begin with. And final call is a buy on NTPC if it starts getting past the intraday pivot of 218.5. Keep a stop at 215. Look for a short target of around 226.
And Sudarshan, what about you?
Well, I have very few stocks which can qualify for any kind of trading. I told you the Nifty itself is very choppy. Sun Pharma is a buy. You know, pharma does its own thing. The market does something else and pharma does something else. So most pharma stocks are buying opportunities as they consolidate. Sun Pharma is consolidating. Buy with a stop under 1110. RBL Bank is an intraday short. Stop above 224. And Rain is again an intraday short. It's broken down from a very large consolidation pattern. That's bearish. Stop loss above 158.
Okay, well, gentlemen, thanks very much, both of you, for joining us, and we'll come back to you in just a bit. We'll take a quick commercial break here. We'll come back with the pre-opening, which is just 8 minutes away. We'll have the management of JBM Auto. The government has approved the outlay of about 58,000 crore rupees for PM e-bus service. What does it mean in terms of bus orders for manufacturers? That's the conversation coming up in just a bit.
Welcome back. Just a few minutes away from pre-opened rates, but a good time to get you some derivative strategies. Chandan Taparia, derivative and technical analyst, and Motilal Oswal joins us on the show. Hi, Chandan. Morning. What do you have for us? Give us your trade on the Nifty as well as a couple of stock picks.
Good morning, Nigel. Thanks for having me. So we have seen some sort of consolidating move in the market from last couple of days. In last 3-4 weeks, the index is forming the lower highs, lower lows. Some profit booking was seen from higher levels. But the good part is even after that, it is respecting to 50-day exponential moving average. Just a couple of days back, the index has broken the key support of 19,560. That was the 20-day exponential moving average. So that is likely to act as a key hurdle. If index moves above 19,560, then only short-term stability will be back in the market. But on the lower side, again, we have key support near to 19,250, and that is 50-day exponential moving average. And with that support, we are recovering from lows in last 2 days. So I believe that 19,250 to 19,560 is likely to be a broader range with buying in selective heavyweights in Nifty index. So I'll use the small decline to buy with support of 19,250. We'll play the bounce to us 19,560 in the Nifty index. But if I talk about other data setup, FI's long short ratio is falling from high levels, but volatility is moving up to us 12. Put call ratio is holding. So all the data setup are giving the mixed skew and indicating the limited downside as well as the upside. So we have to trade the market accordingly, or we can plan for some iron butterfly or time decay strategy with the view that market is likely to move in this 200-300 points range over the next couple of days. Looking at the Bank Nifty index, here structure is clearly weak. We are making lower top, lower bottom. Resistance are gradually shifting higher. Short built up with call writing is visible. So with hurdle of 44,444, Bank Nifty can drift down to us 43,500 to 43,250 level. So mixed set of cues, some range bound bias in Nifty, but weakness is clearly visible in the Bank Nifty index. Talking about stock wise, recommending to buy on Tata Motors. On last trading, we have seen good recovery in most of the auto stocks, including the FNO and non-FNO auto ancillaries name as well. So here I have selected to be with Tata Motors. The stock has formed the bottom with 50-day exponential moving average. We have seen some put writing, and recently the stock has corrected from 665 to 600. So providing a better risk to reward ratio. Some short covering could trigger led by put writing. So recommending to buy with a stop loss of 605 for an upside move towards 650. And apart from Tata Motors, we are also looking the stock like Escorts, M&M in the auto space. Second trading idea, that is buy on Polycab. The strong price setup with breakout of pole and flake. We have seen built up of long position. Consolidation breakout is clearly visible after 18 days. So expecting movement of 4 to 5% from current level. One can buy Polycab with a stop loss of 47.50 and stock can head towards 5,050 level. Last trading idea that is from pharma space. We believe that even if market consolidate, selective pharma stocks can do well. And Lupin is one of the strongest counter, forming high top, high bottom. Trend is intake, longs are carrying. So expecting rally towards 1185. One can buy with a stop loss of 1,019 the Lupin.
Okay, thanks a lot, Chandan, for that. Have a great day. That's Motilal Oswal Financial Services with their views. But Anand Tandon is still with us, so let's get to him. Anand, there was an announcement yesterday about the government going big in this whole electric vehicle space, especially EV buses. So they've announced a $7 billion Prime Minister electric bus scheme to expand the reach to more cities. Now, there are the usual suspects, right, who are getting the orders, whether it's Startup Motors, Ashok Leyland, JBM Auto, Electra Green Tech. But these stocks have rallied quite a bit. From here on, is there more scope for any of these names?
Well, yes, the scheme is very large, and the government is also trying to do a major thing, which is to make sure that they try and guarantee the payment. Most of the problems with the bus buyers, which are the road transport corporations, is that they don't have any kind of payment capability, and therefore there is a plan in place to see if you can create a way that you can guarantee payments to the electric bus players, because most of them will be offering what is called GCC contracts, and therefore they will be responsible for actually maintaining and running the buses to a large extent. In that kind of context, the demand is very high, there is no question. Unfortunately, most of the players, aside from Ashok Leyland, are not in a position to really supply. If you actually see what will actually get delivered near term, except for Ashok Leyland, the rest are still in the process of trying to ramp up their capacity, and it will take a while coming. So I would imagine that you will see it back-ended. The scheme is likely to start only about 6 months from now, and the rollout will be initially fairly slow. So I would argue that much of that is already priced into the market in the near term. Longer term, obviously, there is a move towards EV buses overall, and therefore the demand will be fairly stable. Currently, of course, from a perspective overall of the companies, Tata Motors is probably the best positioned in terms of overall longer term growth, as well as the near term performance, because their numbers will come through fairly strongly. But I would argue that their international business is now overpriced, and the domestic business has promise, but has still to show the kind of growth that one would expect to see, except for the passenger vehicles. With more competition coming in, I think the jury is out. I'm not someone who would be advocating a very large overweight position in this sector overall.
Anand, but the action largely is in this space, manufacturing of some kind, right? Take defense, for example. Again, Cochin Shipyard, Garden Reach, Paris Defense. Actually, it kind of picked up other PSU companies. Dredging Corp was a big mover yesterday. But that's a space. I mean, 2 days in a row now, shipbuilders looking very, very strong. We'll just come to you on these names, Anand, let you ponder. But you may want to hear to this next conversation as well. We have the management of JBM Auto. Sonia.
Yes, in fact, in a bid to enhance green mobility, the union government has approved that Prime Minister e-bus service. So there's an outlay of 57,600 crore rupees. And this service will launch with 10,000 electric buses. So we do know that the government is going big on electrification of vehicles, especially the state transport undertaking. So to discuss the opportunity and the business outlook, we're joined by Nishant Arya, the Vice Chairman and Managing Director at JBM Auto. JBM Auto is a big player in this space and has executed several STU orders already. Nishant, thanks for joining in. Just for the benefit of our viewers, can you explain how this scheme will work? What will the implementation of this scheme look like? When could the tenders be given out? And what is the realistic timeline for this?
No, I think so. This is an excellent scheme which has been really developed, which will be spanning across more than 100 cities across the country, and more than 300,000 people in each city. So more than 300,000 people in each city would be the ones benefiting from this particular scheme. And clearly, it will be taking electric mobility to the grassroots level, and such path-breaking initiatives are covering for the viability gap funding.
I do understand that, Nishant. Sorry, I think there's a little bit of issue with your audio, but I understand that the scheme is large and there's a lot of potential. But I remember you telling us last time around that, sometimes what happens is there's a big gap between the order execution and the actual payment coming through. So for a company like yours, what kind of opportunity do you see here realistically? And in terms of timelines, what are we looking at?
So I think now majority of these cities would be developing their strategy for execution, and it should take about next 6 months for them to develop their strategy, and 6 months post that, so about a year to 15 months for the whole execution to happen and things to get going. And then post that, the delivery of the vehicles would start happening. So that is what I personally see as a timeline, and this is a huge opportunity for Indian electric bus OEMs like us, where we would be looking to see how we could be front runners with everything being developed indigenously, as well as having the right capacities in place to deliver such kind of vehicles.
So, Nishant, good morning. So, states will order and cities will order these buses, and the government, both state and central government, will provide this subsidy, what you call viability gap funding. I mean, that's how this will work?
Yes.
Do you have any details in terms of how per bus, what subsidy, etc.? I mean, how do we have those kind of details?
So I think the fine prints would be coming out very soon for the whole policy document. But definitely they're targeting, because the FAME scheme was targeting primarily 4 million plus cities based on the 2011 census, and this will be targeting 300,000 plus cities. So this would be really taking to the tier 2, tier 3 levels. So both the schemes will be catering to different types of demographic and geographic requirements of cities and states.
Just one clarification. This is everything has to be made here in India for to be able to be eligible for this? I mean, is there any condition like that?
I presume so, that the level of localization which has been there in FAME, it would be either the same or a bit higher than that to promote local manufacturing and make in India truly. And we are totally well positioned for the same.
Okay, I know it's too, I understand that it is in a very nascent stage, so it's hard to put down numbers. But, last time when we spoke to you, you said you've given a guidance that for your own company, you'll do 6,000 crores of top line in FY24 by the end, and a margin range of 12 to 13%. Given that, this is a new development, and you did mention, of course, that everything would flow through 15 months from now. In FY24, FY25, what could your revenue markers be, and any change in this guidance?
No change in the guidance for FY24. As I mentioned, it's 12 to 15 months life cycle. And when the fine prints come and different cities would start making their strategy, I think next few months things would be a lot more clearer as we go ahead. And with that clarity, one can have a clear guidance and understanding what is that we would look forward to in FY25.
Okay. And for this particular, since it's such a large scheme that has been approved, would you look to raise your capex, put any fresh money to work on the capex side, to increase your, manufacturing capacity over the next couple of years? Is that something that you're looking at?
No, so we are already very well equipped with a 20,000 electric bus manufacturing capacity for delivering these buses. And on the other hand, if any such requirements do come up in terms of technology or other kinds of capex, then we'll plan it accordingly.
Is there, should one look at, so this is what we have, it says to augment city bus operations by 10,000 electric buses, right, across almost 169 cities. What could this, what is your share of incremental orders, if you can give us some sense? How should one, if one wanted to get to some numbers, what would that number be, Nishant?
It would be too premature at this stage for me to give numbers till the final details come out for the whole policy, and different cities are developing their execution plans. But definitely, like today also, we have an order book of more than 5,000 electric buses, which we are delivering in the next 12 to 13 months. So we will be looking to get a lion's share and really see that our pole positioning is maintained in this case.
What is your share though right now? I mean, not for the new, because you're already working with these states, cities, etc. You're supplying buses. What is the current share?
So our current share would be more than 30%, including delivered and order book buses.
Okay, 30% market share is what you're saying, right? Yeah.
Correct, yeah.
Okay, Nishant, all the best. I know this is a very exciting times for the space and for the business, for your business, and you're leading it from the front. So all the best for that, and thanks for joining us on CNBC-TV18. All right, that's the word coming in from JBM Auto. 15 months for deliveries to begin. So, but of course, there's a lot of potential for these companies. In fact, a lot of brokerages have written about this as well. This morning, Goldman Sachs writes in a note, and like a scheme to expand reach to more cities is positive for the entire sector. It should augment the already robust order backlog at the company's ends. This is for the entire commercial vehicle sector. So they have two stocks on their radar. There's Tata Motors and Ashok Leyland. Both supply e-buses, and they reiterate buys on both. For Tata Motors, the target price is 710, a big upside to the current market price. And same is the case for Ashok Leyland, target price of 230, an upside to the current market price. However, they are a little unclear about what the implementation of the scheme would look like and what the tender timelines are as well. So they await more clarity on that, but positives coming through there. Let's do one thing. Let's get the 9-10 calls going now, because the market looks like it's going to open absolutely flat. Sudarshan is back with us. Sudarshan, what's the big call at 9-10?
Well, Sun Pharma is a buying opportunity with a stop under 1110.
Okay, all right. Mitesh, what about you?
Buy Infi, keep a stop below 1400, look for targets in excess of 1455.
All right. Well, the other stock that we are looking at this morning is Vodafone Idea. So just get it up on your screen. There was a conference call that was held by the management, and the takeaways don't look that great. So the stock could be under pressure. They say that fundraising continues to be elusive. There's no clarity despite having several talks with investors. No decision has been taken just yet on fundraising. And what that does is, because there's no funds, the liquidity constraints will increase, and that will impact network investments in both the 4G as well as the 5G rollout. So that, of course, is not a good thing. Subscriber decline could hence continue. And they've decided not to take the lead in terms of tariff hikes, but they're happy to follow if competitors raise tariffs. So what this does is create some more duopoly structure. Now, the other incumbent players, Bharti and Reliance, could be beneficiaries of this. JP Morgan has a target price of 3 rupees on Vodafone Idea. So things are going from bad to worse there. But Abhishek is back with us. He's going to tell us about Shriram Finance. Abhishek, over to you.
Well, Sonia, UBS has initiated on Shriram Finance with a buy recommendation and a target price of 2,185 per share. They say that the leader in the organized high-yield used CV financing and two-wheeler segment is having potential to grow. So, like Shriram Finance's changed narrative, that is lower cyclicality, higher yielding product mix and better growth visibility, and revamp post the merger business model that Shriram Finance has put out. So, they think investors are worried about the ability to accelerate the CV growth, that is commercial vehicle book growth, which may be subsidized by stronger growth in non-commercial segments like MSME, two-wheeler, gold and personal loan. So they expect about 16.9% AUM growth CAGR over FY23 to 25, which will be led by 16% CAGR growth in disbursements as well. In this, the growth will be about 12% in vehicle finance and more than 25% in new segments over FY23 to 25. So market underappreciates Shriram Finance medium-term EPS potential growth, given the fact that 15.4% CAGR is what they see between FY23 to 30 versus 12.5% implied growth at current valuations. Back to you.
All right, thanks a lot for that, Abhishek. The stock is high with a gain of close to 100%. Anand Tandem is still with us. Anand, what's your view on Shriram Finance? Clearly, a couple of brokerages quite positive on them. Your view?
Well, yes. I mean, I think overall the space itself is fairly interestingly poised, and there are various options coming in for auto. If auto has to do well, and the commercial vehicles have to do well, Shriram will obviously benefit from the trend.
Okay. Before we let you go, just one more word, Anand, on the market. If this market does continue to, fall further, any large cap stocks that you want to accumulate at this point?
Well, if you do get a weakness, I think I would still stick with the big guys in the space. And since I'm still quite bullish overall on what the top line banks will do, HDFC, for example, has been saying that they are likely to have a problem of maybe 20-30 basis points in their margin because of the incremental cash requirements that they are facing. But a company which can, if you assume that nominal growth continues to be at 10-11% and you are looking at HDFC outperforming, you will have a 15% kind of growth. So a bank which at this size can double every 5 years looks to me as a fairly interesting one to look at, especially given the fact that its valuation is not that aggressive compared to its history.
Just squeezing in one last question on those defense names. Any thoughts? Very strong gains this last 2 days, basically. Cochin, Garden Reach, etc.
Well, yes, the government has been pushing in orders, and with that, you are almost sure that you will get upside. I think I reacted to this a little while earlier as well. See is that you have to look for those kind of businesses where you also have potential for export, and that has to be led by the government again, because these are defense exports. Clearly, among the three services, we have the one that is the most indigenized has been the Navy. And from that perspective, you are getting more and more orders coming through to the shipbuilders. So that is definitely a space. HAL would have been good if they could have been more efficient. They continue to have a large order book, but they are not able to execute to the speed. So, and the valuations have already caught up for much of that. So I would think that if you are looking for defense, we have started gifting away frigates to some of our neighboring countries. Maybe that trend will continue. So I think, the ship area is probably one of the most attractive.
All right. Well, thanks a lot for that. Let's do one thing. Let's head into the market opening now, which is going to be out in, just less than a minute. Looks like it's going to be a flat opening for the market today, just consolidating around the 19,450 mark. The pressure this morning could come in from names like Cipla, there's Tata Consumer Products, HDFC Bank, but let's see how it goes. For now, absolutely quiet opening for the market. The Nifty is down about 20 odd points. The mid-cap index is up about 70 points, so it's better performance for the mid-cap index this morning. And the Bank Nifty once again dragging its feet down about 60 odd points. What's doing well? Asian Paints is up about 1%. NTPC, Adani Enterprises, Bajaj Finance, BPCL, Coal India are all in the green at the moment. And on the losing end, you have, as I mentioned, Cipla, Tata Consumer, Bajaj Auto, Hindalco, Grasim, Nestle are a couple of stocks that are on the losing side. In fact, just a little bit of profit taking as well in names like Cipla, Divi's Labs, etc. that are a tad bit in the red. Otherwise, you'd have to say it's a very, very quiet opening. Nothing alarming either way. Adani Power is in the green, so we'll keep our eye out on that. And something like a Lupin continues to hit fresh 52-week high. So just pull up the Lupin stock, 2.5% higher now. That stock is up almost about 55% this year. Ekta was telling us about the Spiriva generic launch approval, so that is looking pretty good. And a couple of other names as well in terms of, since we're talking 52-week highs, names like Trent, etc. sitting. Suven Pharma is at a fresh 52-week high. So a lot of stocks over there. But otherwise, it is a quiet opening. The Bank Nifty is now in flat territory. The Nifty as well. So just buying time, I guess.
Well, that's right. So a couple of large trades is what we saw yesterday. JSW Energy for the month itself, it's up close to around 25%. Yesterday, you had GQG going in there and chipping in yet again. Remember, they bought in Monday, they bought on Wednesday as well. Today, its stock is cooling down a little bit, pulled back close to around 2%. Adani Power, well, that one was higher, one of the large volume movers today. So that stock should come up for you on the screen. Abhishek told us about that brokerage note on Shriram Finance. Well, the street is taking note of that. Stock is up close to around 2.5% as we speak. Hindustan Copper, yesterday it pulled back big time because of weak numbers and valuations as well. That stock, in fact, is pulling back higher in today's trading session. More or less, it's a quietish start. Though from the broader markets, I think a couple of stocks. Global Spirits is down close to around 3%. That block deal, I think, needs to take place out there. So that stock is down 3% odd. And Nava Limited as well is down close to around 3.5%. Prashant, what else?
Well, IRFC is down 4%. It's the largest volume traded name right now, just under 50 odd rupees. Suzlon, we spoke with the management yesterday. That is coming up at number 2, just under 20 rupees there on Suzlon. So that's Mindtree is down about 0.75%. Moripun Laboratories is down a little bit. Bombay Dyeing is down about 1%. So this is largely quiet. I mean, it's not really... look at Cochin Shipyard, 5.5%. It's the number 1 volume traded stock in the market as we start. So Cochin is up 6% now, actually, 853. And then the number 2 is another shipbuilder, Garden Reach. That's another 5% this morning, and on huge volumes for this point in the day. So third day running, the move continues in these shipbuilders, not broad defense, it's not HAL and others, this is shipbuilders specifically. Mazgaon, of course, is the best performer of the lot, and I guess the other two, Cochin and Garden Reach, are just catching up to what Mazgaon has already done. Indiabulls Housing Finance was up 5 or 6% yesterday, that's up another 2% this morning. We've got Uno Minda, which is up about 3.5%. Shriram Finance we highlighted. HBL Power has been moving up consistently. I mean, there's no correction here. It's, I think, a new high. It's up another 3% this morning, HBL Power. We've got, HG Infra and 63 Moons and Texmo Pipes. Texmo Pipes saw a very large move yesterday, and it's up strongly this morning as well. So this is looking pretty good. I mean, actually from $60, this one, Texmo Pipes, has moved up to almost 90 in 3 or 4 days flat. So it's been tremendous in terms of the move that we've seen here. Market breadth is positive, not quite 3:1, but close, so nothing to really complain. So, we got 100-point dips last 2 days, and then progressively the market got better intraday. Today, I mean, the dip itself is not large at all. We're already down just about 20 points or so, 19,440 in good shape. Pratik Gupta is Chief Executive Officer and Co-Head at Kotak Institutional Equities. Pratik, good to have you with us here. Thank you very much for your time. We had Jahangir Aziz, JP Morgan, who looks at emerging markets, India, etc., from the economy point of view. And his broad point was that, US and emerging markets are doing just fine. I mean, you're at a point where perhaps you got to ignore what's happening in China and Europe. So he says this country-wise emerging market economies are all raising their country growth forecasts, even with all that is happening around the world. So it seemed to be just fine, Pratik. The problem, though, is valuations, isn't it? How comfortable are you, and what are we really pricing in here now with what the market has done?
The longer-term outlook is very, very good. There are very few large emerging markets in the world where you can see GDP growth north of 6% for the next 10, 15 years. And the macro inflation, it's gone up a little bit right now, but hopefully this is a temporary phenomenon and it will come down. So overall, top-down looks fantastic. The problem is bottom-up. So when we speak to our clients globally, they want to invest in India, but when it gets down to stock picking or investing in particular sectors, that's where we run into issues, with most of them complaining that valuations are indeed quite high. If you look at the Nifty, for example, we're now trading at 21 times FY24 PE, about 18 times FY25 PE, for earnings growth of barely about 15% on a price-to-book basis is about 3 times for about 15% ROE. If you look at India's premium versus other the MSCI EM index, we're now at a premium of about 60%, which is more or less in the middle of the range. It's historically ranged between 40 to 80, 90%. So India's not sort of cheap by any stretch of the imagination. At the same time, the longer-term outlook is very, very attractive still, and we also remain quite positive from a long-term perspective. But the problem is, I think in the short term, we will most likely go through a consolidation phase because of the expensive valuations, both at the broader market level as well as at the individual stocks level. One thing I can tell you is we don't expect a very large correction. We believe there's a lot of money waiting on the sidelines, both foreign money as well as local money. If the market were to correct more than, let's say, 3 to 5%, we think a lot of money will come into the market and support the market. But equally, in the short term, next few months, we don't see a big rally either. So we think, unfortunately, we're going to be stuck in this boring zone, plus minus 4-5% for the rest of this year.
Okay. Well, Pratik, hi, good morning, and thanks for joining in. I just want to point out to our viewers that, this whole electric vehicle, this bunch of stocks continue to rally. So whether it's JBM Auto, just want to get them up on the screen, JBM Auto, there's Electra Green Tech, there's Tata Motors, Ashok Leyland. So the street is clearly very, very excited about the potential of this large scheme for electric vehicle buses across the country. And there's follow-on buying there. Pratik, good morning. So since the market is going to be a bit boring, let's talk about individual sectors, right? top of mind is this space, I mean, electrification of vehicles. And a lot of people believe that despite the 50-60% rally, this is a structural up move that could go on for years. Are you in that camp as well? And what should investors do here?
Yes, you're right. We agree with the structural story. And I think the more important thing over here is to first look at some of the incumbents. This is actually because of this theme, this risk of disruption for the incumbents. We have been somewhat cautious to depending on the stock, often negative on some of the incumbents in the two-wheeler space in particular, where we think the disruption will be the biggest. But equally, as you rightly pointed out, we think there will be opportunities for the auto ancillaries who are involved with the EV space, and those who have good products, good design technology, good manufacturing capabilities. The only issue over there, however, is in the short term, you may run into 1 or 2 quarters of somewhat weakish demand. The world is slowing down. Decision making is getting elongated, and I think more importantly, valuations have gone up again. These stocks are not cheap by any stretch of the imagination anymore. So you'll have to, again, even with these stocks, you've got to have a 3 to 5 year sort of investment horizon to be investing in these stocks right now. But longer term, yes, we agree with the EV theme. We think these are great businesses. But equally also watch out for the disruption risk for the incumbents, some of whom you may see some negative earnings surprises over there in the coming quarters.
Hi, Prateek. Good morning. Nigel on this side. Prateek, what about the IT space? How are you all positioned out there? Global economies are likely to slow down in the second half of this year. And there's, some of these numbers are pretty ordinary. But yet some of these stocks are holding up. Maybe, they continue to find preference. How do you approach these stocks? I mean, will it be a place to hide? If you have a longer time horizon, do you think that it's a good time to chip into some of these IT names, or would you stay away?
Nigel, hi. On IT, I think it's still a bit too early in our view. One of the reasons why these stocks have done well is because the US inflation data has come in softer than expected, raising hopes that the US may achieve a soft landing. And frankly, the jury's still out on that. So it's still a bit too early. We are still continuing to see a slowdown in discretionary spending, and especially in IT companies which are focused on the BFSI and the telecom space in particular. We think there is a risk of further earnings downgrades in the coming quarters. And the next 2 quarters, we don't see scope for much earnings upgrades. So over there also, we think given where valuations are, we're going to be range bound. But yes, the longer term outlook on a 3-year kind of view, it still looks attractive. I think the Indian outsourcing story will only continue to improve. And also globally, we are seeing more and more of the cloud migration, a lot of apps being built for that, a lot of software development requirements for that. So that story continues. The other way to play it is also focus more on the large cap IT names, which are less vulnerable to a slowdown in discretionary spending versus the mid caps, where the client concentration risk is a lot higher, where the product, the service lines are not as diverse as you have in the large cap names. And the large caps tend to weather a downturn or slowdown much better. So, and given where valuations are, where some of the mid caps are still trading at par or above the large cap names, our preference would be on the lookout for small corrections, which we expect over the next few months, and buy into the large cap names.
Prateek, you guys are also, Kotak is also one of the largest players on the investment banking side, on ECM, the equity capital market side as well. And the transactions are through the roof. Promoters are selling, private equity is selling, but you've got enough buyers on the other side as well. What's the broad kind of thinking within the team at Kotak? In terms of how you're looking at all of this activity? The general kind of refrain is, well, insiders seem to be selling, so it can't be good. But I'm assuming it's not really that clean, right? I mean, shades of grey. So tell us.
And you're right. We don't think just because a PE or a promoter is selling, it's necessarily bad news for investors in the long term. There have been numerous instances over the last 5-10 years where promoters or PEs have sold out and the stocks have gone on to do really well. A lot of the IPOs which have come out in the last 2-3 years, they were mainly PE exits, and some of them have done quite well. But I think there is a broader question, and that's a broader concern, and that's what's goes back to our view that the markets will stay range bound. Is this paper supply which is likely to come through both in the form of IPOs as well as blocks? Now that the earnings season is over, when most of these companies and these insiders are out of their quiet period, out of their sort of locked up period, etc., you will start seeing supply coming out, and in the next 45 days. You could see a lot of supply hitting the market. But equally, like I said in the beginning, we do have global investors as well as local investors who are eyeing the market, looking for stock-specific opportunities where there might be a little bit of a discount. And remember, a lot of these global investors also worry about liquidity, because if they're buying, let's say $20 million, $50 million, $100 million of a stock, it straight away tends to have an impact on the stock price. The price shoots up. So when you get a block, that's an opportunity for them to deploy capital. So to that extent, we think a lot of these activities will go through. We at Kotak are definitely seeing a lot of inquiries, a lot of activity on our side. We think it's going to be quite a busy next 40, 45 days. So let's see how things pan out. But overall, I don't see the market still correcting too much because of this paper supply, because of the underlying demand.
Forward to chatting up with you rather soon. For the time being, though, let's turn our attention to Honeywell. Well, they reported a mixed set of numbers, good growth on the top line, though margins were joined by Mr. Ashish Gaikwad, the managing director of the company. Hi, Mr. Gaikwad. Good to speak to you as always. Well, your gross margins were maintained, which is a positive. Close to around 47, 48%. It's been in that vicinity. However, the EBITDA margins got diluted because other expenditure spiked up. So explain to us what went on with that other expenditure. That's the reason why the EBITDA margins did see a miss.
First of all, very good morning to you and all your panelists. Nigel, let's look at the good things first. As you mentioned, we had reasonably good gross margins. Also, if you look at the order book, it is about 41% higher than the previous quarter of the previous year. Right. And so we are looking at the growth that is coming in, which is building the backlog. The revenues also have gone upwards of 18.5%. So I think that's going well. And that gives us the backlog to burn over the next few quarters. And lastly, the earnings per share, they went up as well. So that's a good part of the story. You're right that there have been some pressures on the margin. I don't want to get into the other costs that have come in, but essentially this is about three factors that are affecting our margins right now. So the first one is, of course, the competitive market. The domestic market is growing in India compared to the stable exports market, and therefore that puts pressure on the pricing when we compete. The second is about our long cycle businesses, the projects businesses, where we take fixed price contracts, most of them, and therefore when there is inflation and the input prices go up, then that affects the overall margin. And the third one I would say is there were some one-timers that came in and we had to deal with those. So that has kind of impacted overall margins.
Okay, all right. Mr. Gaikwad, just to confirm that number, the order intake is up by close to around 40% on a year-on-year basis. Yes. Is that correct?
That is correct. Absolutely.
Oh, so you're well placed then for growth from year on. I just wanted to further dissect the revenue number. A couple of years in the middle, the export contribution went down, which in turn put pressure on margins. Now that perked up back to above that 1,400 crores for the past year. For this year, what kind of a contribution are you expecting from exports? And for the exports part of business, what kind of growth should we look at? Mid-single digit? Should we look at a double-digit growth?
Yeah, that's a question that you have always asked, Nigel, when you look at Honeywell. So first of all, when you divide the pie into exports and domestic, right now the growth in the domestic market is really good, and we must make sure that we participate in that growth in the Indian market. So when we do that, certainly exports, the overall size of the exports pie starts to look a little lower compared to what it used to be. Right now, when you look at our last year's performance, FY23, it's about 41% on exports, and remaining on the domestic side, which was in terms of absolute numbers about 1,400, slightly above 1,400 crores. When I look at our exports business, this is not just a few countries. We are very much spread diversely around various regions, North America, Latin America, Asia, Middle East. So, sorry, go ahead.
No, we got that. For the paucity of time, I just wanted to get a couple of more numbers out of you, Mr. Gaikwad. Good morning and thanks for joining in. I wanted a view on margins because the operational performance has been deteriorating if you look at it both sequentially as well as on a year-on-year basis, right? I mean, in Q1, your margins are now sub 13%, but you used to at one point in time enjoy even 16, 17% margins. Just trying to understand what is the expectation as we move along. Is there more pressure there on the operational front?
Morning, Sonia. Yes, I think there is pressure. And by the way, we are at about 15% odd PBT and about 11 on the PAT. And, that's a reflection of the margins, the question that you asked. We believe that we will have performances in that range in the time to come. And of course, we will try to find a better mix whenever there are opportunities. But I think that we are still in the leading group of the pack in the industries when it comes to margins.
So when you say that, you're in the leading group as far as, compared to the industry when it comes to margins, but what is your own range? I mean, what are you looking at? Do you think it would be in this 12 to 14% band? And in the domestic, margins are seeing a bit of a drag as well. So what is the expectation there over the longer term?
So our business model is such that we have to create the installed base. And therefore, when the growth is happening, we have to win the projects so that we can go later on and then add on top of it, provide life cycle services. So till the time the growth happens, we would like to participate in building our installed base. And therefore, we would be in the same margin range that you see for some foreseeable time.
Right. So at around current margins is what you'll maintain, mid-teens odd.
Yeah, hard to speculate right now. I won't want to do that. Okay. But I think that's what I would.
Mr. Gaikwad, I just want two numbers in terms of growth, because as you're indicating, the India story is, very much alive and kicking. And, that's where growth is going to come from as well. So, when you joined us the last time, you said maybe you'll grow at 2 times what India grows at. So we were just trying to extrapolate that. And I think the number we came to was early teens, 1.5 to around 2 times odd. Now, given the kind of start that you've had, do you want to revise that? Can we see growth in this year? That is FY24 for Honeywell as a company consolidated entity. Grow by close to around maybe late teens. Is that possible? And just some clarity on that exports number. Last year it was 1,400 crores. This year you said how much will it go to?
I did not say anything about the coming year, right? I just said that last year it was 1,400 crores plus.
Yes.
And we would be, growing at the world's economic growth rate. And domestic growth is higher. Therefore, we'll see the domestic business sort of growing faster than the exports.
Okay. But for the company, you were targeting growing 2x the GDP. So coming back. Please go ahead.
Coming back to that point, as you can see that we are increasing our order books, the 41% that I mentioned to you earlier. Also, if you see the last year's growth, we talked about 18.5% revenue growth. And so, depending on the mix, because we do have short cycle and long cycle businesses, as I've explained to you earlier, we would turn some of that revenue in the backlog in a longer term. So we would still believe that our growth rates, we would absolutely try to achieve 2 times that of GDP. That would be our ambition. But it depends on quarter to quarter mix of the business.
Okay. I wanted your thoughts also, to look slightly far out on the renewable energy market as well. What is the kind of traction that you're seeing there? What are the new orders in the renewable energy market? Any clarity that you can give us?
Certainly. I think there are 2 mega trends on which we are continuously working on. The industrial digitalization and automation and sustainability in the industries. And so on the sustainability side, as far as our play is concerned, it starts from providing automation to the gigafactories. There are multiple battery manufacturing facilities being talked about. We also play in the automation of electrolyzers, which are coming up in a large quantity in the time to come. We also have automation that goes into the renewable fuels like ethanol. Ethanol is coming up in a big way as a part of blending into gasoline or petrol. So I think we have a play there. We also are in the business of providing what is called as battery energy storage system, which is juxtaposed to the solar plant. So all of that sector, which I mentioned to you, and I heard you guys talking about the EVs that is a hot topic today. We provide sensors that will protect the batteries from heating up, and therefore a battery safety system that we provide. It's a small part of the whole system, but certainly that's good news.
All right, Mr. Gaikwad, very quickly, the former president of Microsoft India has joined Honeywell India. I think Anand Maheshwari. Does he have a role to play in the listed entity as well? Is there any kind of strategy change?
So Nigel, just a correction. Anand Maheshwari is a colleague, ex-colleague, and now comes back to Honeywell again. His role is that he's the president of high growth regions in Honeywell. It's a global role. He has the responsibility for China, India, Latin America, Middle East, Eastern Europe, etc. Right? So he has a much larger role to play, but he does not have a direct role in Honeywell Automation, the entity that we are talking about, and we will collaborate. Of course, we will collaborate and work together as he joins us.
Okay, all right. All the best, and thanks a lot for joining in and giving us a lot of details about the business. That's Honeywell Auto saying they aim to grow at 2 times that of India's GDP, and they're very optimistic on the mega trends, which is digitization and sustainability. Okay, those seem to be the buzzwords, and Honeywell is sort of making the most of that. Let's slip into a quick break. On the other side of the break, we have Ashok Kumar Tyagi, the managing director at DLF, to discuss demand trends in the industry and the outlook for the company. We'll also have JN Gupta, the former executive director at SEBI and managing director at Stakeholders Empowerment Services, and Abhishek Dadu, partner at Khaitan & Co, to discuss SEBI's decision to review delisting norms. Hi, welcome back. This is Corporate Radar, and on our radar right now is realty major DLF. They are re-entering into the Mumbai property market with an SRA project in Andheri of 2.5 million square feet. Do note the company has also managed to reduce its debt need to deleverage its balance sheet, and the street is like that. To discuss business opportunities and demand trends, we're joined by Ashok Kumar Tyagi, the managing director at DLF. Mr. Tyagi, good morning, and thanks a lot for joining in. Before I ask you about all of these plans with respect to the residential business, the move in Mumbai, etc., I just want to understand that recently the promoter entity sold a bit of stake. I wanted to know what the reasons for that are, and is there any plans to sell more stake in future?
Okay. So, good morning, Sonia. the promoter entity, I mean, all the promoters put together owned about just, short of 75%, which is the maximum public float. KP Singh, who is the chairman emeritus of the company, and in that sense, who's sort of been the guiding light of the company for the last 50 odd years, had a small stake of about 0.7%, which he sold off for about 750, 800 crores. And predominantly at the stage of life that he is in, he wants to, set up a charitable foundation and use this money as the corpus for that. So that was really the primary driver for the stake sale, the way we understand it. I don't think that there is any move by any of the other promoter families by any of the other promoter groups to liquidate their stock further. But yes, this was, I think, a one-off, predominantly driven by the chairman emeritus's, vision for setting up a charitable foundation now.
Okay, so you're confirming, or rather assuring investors that this was a one-time thing and there would be no more big stake sales by the promoters. Is that fair to assume?
At least not in the short term, for sure. I mean, I can't give you a 20-year guarantee, but yes.
Sure, of course. No one can give a guarantee for about anything, right, in the next 20 years.
But
another thing I wanted to check.
And also, I wanted to sort of reassure you further that that our chairman, Rajiv Singh, who owns the bulk of the promoter stake, not a single share from him was sold.
Okay. So not a single share from Rajiv Singh was sold. Got that. And that's important, actually. It's an important clarification. So thank you for that. I also wanted to understand the REITs listing, right? And we've spoken about this at length.
As we had disclosed at that time, with a reasonable degree of enthusiasm in conjunction with GIC. I mean, 2 years, obviously, a lot has changed. The COVID, induced vacancies. Then the higher interest rate regime kicked in. So, I mean, the sort of, the current listing performance of the listed REITs in India has not been very great. So obviously we are ready in that sense from a listing standpoint. We had certain restructuring and mergers, etc., to be done, which are now all underway. So there are no structural, speed breakers to the REITing process. But I think the REIT will happen driven by two factors: A, as and when the interest rate regime and the overall markets improve, and B, frankly, to a large degree, it will be driven by when GIC wants a roadmap for at least, either a mark to market or a potential exit for their investment in CyberCity. And frankly, I mean, I don't think that either of them is going to happen in the short term. But yes, we are REIT ready. We continue to be REIT ready. But I do not think that the REIT is happening in the immediate short term.
Okay, not in the immediate short term. And it'll also, an important indication will be when GIC wants to, as you said, mark to market. Got it. Mr. Tyagi, good morning. Prashant here.
Sorry, Prashant, just to clarify further.
Yeah.
I mean, I would not be wrong in saying that for us, the primary driver of the REIT will be GIC's desire, because we as DLF, frankly, do not believe that it will be a hugely value accretive thing for us. Neither are we looking at divesting our own stake in CyberCity.
Yeah.
So, but obviously, as a responsible partner to GIC, as and when GIC does decide that now is the good time to sort of go to the market, we'll support all those efforts.
No, that's understandable. And thanks for that. Mr. Tyagi, you also said as one of the conditions, as and when market improves, I mean, market is has been an improved state for some time.
The market is not the stock market. So if you look at the interest rates today,
I'm saying I don't mean the stock market. I mean property markets. I mean, I remember last time when we spoke. Yeah, I mean, and so even with interest rates where they are, and things are looking pretty good. So I just want you to kind of tell us, since the last time we spoke, how things been. 40 units left. This is during our last chat. All of them gone.
No, not all of them gone. But yeah, so Camellia continues to obviously sell at a fairly high clip. There are, I think, now maybe about 30 odd units left. I think they are selling at about 8 to 10 units a quarter. The sales performance, I think, across the board, from the more moderately priced end products in the farther sectors of Gurgaon or Panchkula to the luxury and the super luxury segments like Camellias. I mean, it's been across the board enthusiastic response which continues. To some degree, our success in Arbor in Q4, where we, as you know, we sold almost 8,000 crores of apartments within the quarter, did mean that for the first 2 quarters we were slightly short of launches. A lot of our launches are in the pipeline now, and I think in the second half of this year you will again see, some very significant launches coming to the market in both the premium and the luxury segments. And I think the residential market, even if you look at the performance of the other listed players, the residential market, I think across the board and across geographies and across economic brackets, I think is doing very well. Ironically, if at all, the one segment which I think is not growing with as much clip is possibly the lower end affordable, where potentially the mortgage loan rates, have had a higher impact than they've had at the upper end of the market.
A sales number of close to 13,000 crores approximately. Do you think you'll outbeat that number? I think you as well have hinted that that's gettable in the past. And also there?
Okay. So, Nigel, two things. One, on the, if you look at our analyst presentation of June end, we had an opening inventory of about 5,000 odd crores, which was by inventory, I don't necessarily mean finished goods. I mean inventory of projects which had been launched. And we have a new launch pipeline during the year of almost 20,000 crores. So we will have a total availability of almost 25,000 crores of products to sell. We are assuming that somewhere what our guidance has been is about 13,000 for the year. But obviously, as the Q3 and Q4 launches happen, and if they do meet with a more enthusiastic response, like in the case of Arbor last year, these numbers could have an upside risk, if you will. But our official guidance stays at 13,000 crores, which is what we have told the market also. On the rental piece, the offices leasing, which had actually, the vacancy levels, which had actually gone up to almost 15-16% at the peak of COVID, are now back to about 10%. There also, the number is slightly skewed because of the SEZ vacancies, which are higher than the non-SEZ vacancies. And I think there's no immediate short-term solution to the SEZ vacancies because everybody, I think the entire industry, including the listed REITs, are waiting for the government's DESH guidelines to be notified, which hopefully, should make it easier for SEZ units to be also used for non-SEZ purposes. So we are all waiting for that to happen. But I think overall, we are now at a 90% odd occupancy level. The occupancy level in the non-SEZ spaces are in the early 90s. The occupancy level in the SEZ spaces will be slightly short of 90.
Okay, before we let you go, the main reason for which we invited you, right?
Okay, so obviously there is competition. If you recall, we had one project in Mumbai in partnership with Shaparji, and like at least a moderate entry into Mumbai market if we found the right product. This particular project near Andheri has potential of almost 2.5 to 3 million square feet of saleable area in the LOIs that exist, with a potential for an upside later on. So you guys know the pricing in that area far better than us, but we do believe that I think eventually this could be a significant amount of maybe a 6,000 to 7,000 crores of sales potential on the phase that is currently available, and potentially grow forward further add on. The first launch of this project should hopefully happen, I'd say within the next 9 months from today. And it should be about 900,000 to 1 million square feet of saleable area, which I think will translate to whatever RERA carpet it translates to. And I think that should be hitting the market hopefully before March, latest before June.
We wish you all the best, Mr. Tyagi. Thank you very much for joining us. And, we'd like to speak more about the Mumbai market on our next chat. Thank you indeed for joining us here on CNBC TV18. Well, that's DLF for you. The market is down a little bit more. It was holding with about a 20-25 point cut. We're down about 60 points now. Just look at the two names, the shipbuilders. Cochin is up 11% now. So there is some serious concerted buying going on there, and huge volumes, Cochin. And I think it's up 40% in 3 sessions. So just complete re-rating in 3 days flat. Garden Reach, I think, is up about 40-45% as well in these 3 sessions, today included. So this has been quite incredible, the run on these names. All right, let's just a bit in the market, but let's talk to the experts on what SEBI is proposing to do via its consultation paper. So SEBI is proposing reforms under 4 key segments as far as the delisting of companies, listed companies is concerned. The basic primary thrust seems to be to try and make it easier for companies to delist. So instead of the reverse book build process, which has been in some cases a bit of a thorn for companies trying to delist, SEBI is now proposing in the consultation paper that there could be a fixed priced option as well. So that's one of the many things which SEBI is proposing. We had this SEBI chairman at the last press conference, chairperson at the last press conference saying that she doesn't want Abhimanyus in the market, which basically means she doesn't want companies to be able to come to the market and not get out. I mean, if the companies do indeed want to get out via a delisting. Mr. Jayan Gupta is with us, former executive director at SEBI. We also have, he's also, of course, the managing director at Stakeholders Empowerment Services. Abhishek Dadu is partner at Khaitan and Company. Gentlemen, great to have both of you here. Appreciate your time here on CNBC TV18. Mr. Gupta, if I can begin by asking you, this is a consultation paper, there'll be feedback sought and then rules will be published. But does this, I mean, if you've gone through this, does it make it easier, the process of delisting from a...
Because I was part of the subcommittee, so I know each and every aspect of it. See, the idea was very simply that into the data of delisting offers and found that there could be situations where the market's expectation and the company's expectation were not meeting because of certain regulations, and companies were not able to do something better. So based on that, it was decided that why don't we allow a counter offer in a different manner? Because earlier counter offer was only possible if the price was not liked by the acquirer, but the 90% plus shares were tendered. So here was a situation where even 90% shares were not tendered, but there was a possibility of counter offer. The reason were two, because in an initial delisting offer, generally the shareholders were having such a high expectation that the company is desperate to delist, so they will pay any price. So sometimes, I would say sometimes some investors were bidding at irrational prices. You would have seen that some 20,000 rupees with also bid in some offer, something like this. So in order, the table is given in the consultation paper that based on promoter shareholding and public shareholding, what is the minimum that to bring some sort of a semblance to the process, let us calculate the volume weighted average of the bids that up to 90%, more than 90% has come, the calculation happens till 90%. If less than 90% has come, calculation happens at up to the entire bid that is received. So this is one way where it is trying to facilitate. How much it will be successful, only the market and time will tell. And secondly, I would say that no regulations are final, because every time when a regulations are put to marketplace, then some irritants happen or some problem happens or some cheating happens, whatever, everything happens. So regulations will go through a reform every time. So Mr. It Gupta, is one more step towards making it easy.
Yeah. No, Mr. Gupta, does it shortchange investors? Because this is a process through which, there are some instances, absolutely agree with you, where there is, there are people bid irrationally, right? I mean, to try and force the company, and it just doesn't make sense. But was that found, as you said, I mean, a study was conducted, was that found predominantly to be the case? Because this was also, the reverse book bid was also a way for common shareholders, retail shareholders to find, to get, the maximum price available to them. And nothing wrong with that.
No, I agree. So what we are saying again, you understand that there is no short-changing of the investor, because option is always coming where there is a price which has been discovered based on the demand and supply position in the first. Yes, it is only after 90% is reached, then there will be a situation where either investor tender at that price or remain the listed price. Again, I am saying,
got it.
And Abhishek will agree that there will be people in the market, there will be bankers in the market, there will be lawyers in the market who will try to suggest 100 different methods to the promoters to do something. If anything is noticed by SEBI, SEBI will certainly take a further corrective action and do further reform. So the idea is that neither side should be suffering. So there was a situation where one thought that promoters were not having various options. There was only one option. This is one more.
And I wanted to just also touch upon the what this would mean for, say, holding companies, because there is a special bit in these holding companies usually traded at a big discount, relative to the value of the investments that they own in listed or unlisted securities. Go on, Abhishek.
Thank you so much for having me, first of all. And I fully agree with Mr. Gupta. I think the fixed price delisting is bound to be a game changer in the current market. We've seen historically that the reverse book build, while it's a more democratic process, it ultimately tends to failure in the delisting because of unrealistic price expectations. So a fixed price delisting is bound to streamline the market a lot more. And like the SEBI chairman said, right, the option for you to come into the market should come with the option for you to exit the market. And that needs to be a realistic option. It shouldn't be one where you are effectively held at mercy by certain shareholders. Having said that, on the holding companies, again, I think it's a really progressive move by SEBI. Like you rightly said, the holding companies usually trade at a substantial discount because there is no perfect way to value the underlying securities. And the long-term objective is that these shares will be held by the holding companies. So a solution that SEBI has come up with there is to say that we don't follow the regular process, not of a reverse book build, nor of a fixed price delisting, because neither of these are bound to satisfy the public shareholders in a true price discovery method. Instead, they have proposed a method where the holding company is effectively able to pass on the underlying listed shares to the public shareholders, as well as the benefit of unlisted stock or real estate. It is quite common for a lot of these holding companies to not just have listed securities, but also have some amount of unlisted securities or real estate assets. So those can be monetized in the form of cash, and that is passed on to the public. And then the delisting effectively takes place by way of an NCLT order, which is a tribunal process. So that makes the process a lot more streamlined in a way and enables a true exit.
Abhishek, just 30 seconds. You must have gotten a sense of feedback from companies and the ecosystem which works with corporates on matters like this. I mean, is the feedback positive? Just
it's very positive.
A straw poll.
I must tell you, this is something that the industry has been trying to battle for a very long time.
Yeah.
It's a wonderful move. We are all looking forward to it coming into play, and I'm sure it's going to be immensely helpful for the whole industry, no doubt about it.
All right. Well, so it does simplify quite a bit from a corporate perspective, but we will get to hear, and the feedback comes into the consultation paper from others as well. I mean, shareholder associations, etc. Thanks very much, Mr. Gupta and Abhishek, for joining in. Great to speak with both of you here, and good chat. Thank you. Well, 80 points lower on the Nifty is what we have, so it's a bit of a reverse kind of reaction as compared to the previous 2 days. So the market at open did not correct too much. We were down just 20-30 points, but progressively we've come off. So holding at the just under the 19,400 mark, almost at the low point of the day. We'll take a quick commercial break here. Mitesh will be with us with some technical trading ideas. Stay tuned for that conversation.
Welcome back to the show. Well, for now, the market is down almost about 0.3%. Nothing major, but just kind of choppy. But the space to be in really is the mid-cap. So the mid-cap index is now at the high point of trade, up about 170 points. And a lot of big moves coming in, whether it's Cochin Shipyard, JM Financial, Coffee Day, DB Realty. A lot of the laggards are starting to move now in the markets. But let's get Mitesh Thakkar into the conversation. Mitesh, this is a very strange market. It's neither falling nor rising. It's sort of stuck in this range. But for now, when this consolidation phase continues, what do you do with individual names?
I think actually, that's the way to approach this market. Given the fact that it's a very choppy and now slowly narrowing market, I think you will not see much traction trading the indices. So I think the approach would be clearly stock-specific basis. I have a buy on IDFC Limited. I think it's just on the verge of breaking into a fresh swing high. So buy above 122 here. Keep a stop at about 119.5. Look for a target of 130 to begin with. And the other one which I like is Titan. Disclaimer, we have recommended this to our clients. Titan is also on the verge of breaking out of a bullish pattern. The breakout happens about 30.60 to 30.65. So buy about 30.65. Keep a stop at about 30.30. And look for targets of around 31.45 to about 31.50 on the upside.
Mitesh, I know you have Mazgaon in your portfolio. I remember you telling us. But this Cochin Shipyard and Garden Reach, they've caught up in a very big way this week.
So, Prashant, I think a very strong move has started. I think, particularly for Cochin, the week, I think, and we still have today and tomorrow to go, 37% move has already happened. And the way this has pulled the medium and long-term indicators on the upward trajectory, I think the stocks will make this stock will make at least a few more higher highs before cooling off. So my sense is that they should, on an extension-based target, I think it could be anywhere between about 1,050 to 1,100 to begin with, and in a very bullish case scenario, even 1,200 could be tested for Cochin Shipyard. So very positive about it.
Okay, thanks a lot for that. So that's on Cochin Shipyard, but let's shift focus to the commodity markets now. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Sonia, thank you. I'm looking at the crude oil prices, and good news clearly for India, as we are the major importers and consumers of crude as well. And we have seen the prices come off the way they were going up as well. So it's a fourth straight day of decline for the crude oil prices. We are trading at a 2-week lows, and 5% down in 1 week itself is how the prices seem to be really working with. There are a lot of factors which are weighing onto the markets right now. To begin with, it has to do with the dollar index, which has continued to gain for the last 4 weeks, and it's trading at a 6-week highs right now. Apart from that, it also has to do with the US Fed policy minutes that came in yesterday, which are signaling more rate hikes ahead, and that's weighed on across asset classes. The market's also looking at the Chinese economic numbers. All of that data, information coming in from China is weighing on. So the China Trust Fund says that they missed payments on investment products. So the real estate is an area where China continues to stay a laggard. But apart from that as well, whether it has been about home prices, trade data, investments, manufacturing, retail sales, every number that came out of China for the month of July on a month-on-month and year-on-year basis has been on the weaker side. And even as China has cut the key policy rates for the second time in 3 months, markets still are waiting for a big bang stimulus measure or some meaningful big stimulus measure to come in for the property there. Apart from that, the markets also are looking at the US production, which has continued to run up. The US production now at a 3-year highs of 12.7 million barrels per day. The market has been anticipating or estimating that 12.8 million barrels per day of an average is what you could see 2023 hit as well. Now, this is very close to the all-time high that we saw in 2020 at 13.1 million barrels per day. Not too far away from that, and that is what is bothering the street. So even as the OPEC and allies and Russia has been cutting output, with the US output increasing and near all-time highs, the all concern about tightness perhaps in this quarter and the next quarter seems to be easing away, and that's weighing onto the prices also. Is the reason, even as we saw the prices gain up all the way from $65 in the month of May to around 87 in the month of August, we seem to be just about holding 82 or 83 right now. So profit taking clearly coming in for this space.
All right, Manisha, thanks a lot for that. Well, moving on, sources to CNBC-TV18 indicate a very interesting development may be underway in the Indian footwear space. Which are the companies in focus? What would be the...
Between two very large footwear companies, we understand that Bata India is right now currently in talks with Adidas, and this is, we understand that there could be a strategic tie-up in the Indian market operations. We also understand that the talks between the two companies are currently in the final stages, and we understand that the final deal contours are right now being deliberated by both of the parties. We also have written to both Bata India as well as Adidas. Both of the companies have yet to respond to us, but we understand that one of the key factors behind this particular deal, or the rationale behind this particular deal, is that Adidas India would like to actually tap into Bata's very strong retail store footprint. Remember, Bata has a very strong network of almost 2,100 stores in India across 700 cities, and we understand this could be one of the key reasons for this particular strategic tie-up. We are still awaiting clarification from both of the companies.
All right, Vivek, thanks very much for that. And you can see as a stock there, 1665 or so. That's an interesting bit of information which is coming through. More on this later. We'll take a quick commercial break here. Our special segment is The Economy with Lata coming up in a bit. We have Kamaksha Trivedi, head of global forex at Goldman Sachs, speak about the churn in global currencies and inflationary trends in India as well. Stay tuned.